to 7 in our final segment for the year with Fisher Funds. We have Chief Investment Officer Gardyne here to run us through the year that was and things to watch out for in 2026. Ashley, it was a bit of a whirlwind year, right? We had Liberation Day, tariffs dominating a lot of the conversation. So looking back, how unusual was that time, do you think? And what did we learn about the way that markets reacted?
Yeah, it was certainly an unusual year, and I think we all expected that with the incoming Trump administration. There was always talk of tariffs, but I think what caught markets off guard back in April was just the size of the tariffs and concern that it could escalate into a global trade war. As we know in hindsight now, though, that didn't happen. You know, cool heads prevailed. There was negotiation, discussion, a lot of rollback eventually, and at the same time there were other things going on in markets too. It wasn't just the tariff headlines. There was this sort of growth in AI, which was driving markets higher as well. So I think it's an important reminder for investors that the first headline or shock might not be the thing to focus on. There are other drivers at play as well, and reacting to the short-term news can actually be damaging. And actually markets are up despite April, which everyone remembers vividly. Markets are up about 20% for the year. But I think generally KiwiSaver investors know this now. Over the last 17, 18 years, we've had the global financial crisis, COVID, Brexit, a whole bunch of different events, and each time markets have sort of moved higher with corporate earnings, and people I think know now to hang in there.
Yeah, a lot of the advice at the time was just don't check your KiwiSaver,
right,
stay the course, right? It'll be okay. You mentioned AI. It sort of feels like it's been the year of AI, not just in development space, but also stock prices in AI. What's your take on how that's sort of gone this year?
Yeah, we think it's going to be really transformational technology, and I think if you think about the internet, back in the 1990s, you could see the potential, but you couldn't quite see how that would manifest. And I think if you think about businesses now like Netflix or Uber, you couldn't have really predicted them in the 1990s. And even like software as a service or cloud computing, things that wouldn't have been possible without the internet, are huge industries now. And I think we're going to see a lot of change as a result of artificial intelligence. So it should be really positive for growth and productivity long term. But at the same time, you do have to be a bit wary. Whenever there's a technology with so much potential, investors tend to get quite excited, enthusiastic, and we're seeing that at the moment with valuations of some of these AI stocks really moving up to pretty high levels. And even if you can pick the technology right, it doesn't mean you can pick the stocks right. And I always think a good example of this is internet search. We all knew in the late 90s when I was doing my homework that search was going to be a great thing, whether it was Yahoo or Excite or
Ask
Alta
Jeeves.
Vista.
Don't forget Ask Jeeves.
All these great technologies, but if you invested in any of them that were listed in the 90s, you would have done really poorly. And Google, that listed in 2004, was the winner. So you've got to sort of separate the technology from the investment landscape and just pick carefully.
Okay, so using your crystal ball, bearing in mind all the things that we've seen this year and the unpredictability there, can you look into next year and what are you expecting?
Yeah, we're reasonably optimistic, and perhaps if we separate the globe from New Zealand for a minute, and around the world we've got reasonably solid growth. The US is growing strongly, partly because of all this investment into AI infrastructure, energy, but even in Europe we've seen quite a spike in fiscal spending to bring more energy production back onshore and energy security given the situation in Russia, and also a lot of spending in areas like defence. So developed markets are reasonably strong, unemployment's low, and that combined with the fact that finally we've seen inflation start to come down and central banks start to bring interest rates down as a result, I think consumers will find they've got a bit more money in the pocket, and that'll be supportive. And even here in New Zealand, we've been a bit slower, and our central bank probably held interest rates too high for too long, but that has changed quite a bit in the last few months, and we're starting to see that now roll through to mortgage rates. I think the Kiwi consumer will have a bit more money in the pocket as they move through 2026. And if you can combine that with the rural sector, which is actually doing pretty well, I think we're reasonably optimistic about the year ahead.
Ashley Gardyne, that's good to hear. CEO of Fisher Funds, Merry Christmas to you and the team. Thank you for joining us this morning.
Merry Christmas and thanks for having us.
Pleasure.